Hey, everybody, welcome in to our latest Trade to Black podcast. I'm your host, Shad Dales, and a lot of reform conversation we've had over the last week and a half. Let's take a quick break, get back to some of the investment sides. And as we know here in the back end of 2025, a lot of capital is shifting, debt markets are tightening, and distressed assets are creating new opportunities both now and probably into the future for a lot of companies in this space. So we need to find out what are the trends, because in the event that we do get some sort of reform, what does this industry look like from a finance side and some of the trends that we could see? So with that, let's welcome in AV here on a Thursday. Good to see you. How are things?
Good to see you. It's good. We get to actually run through the numbers and talk about capital markets versus policy. So these
Kind of nice.
conversations, these conversations with Peter are usually quite refreshing to be able to get back to the numbers and actually talk shop as far as the finance aspect of the industry goes.
Yeah, with that, one of the smartest people I know from the cannabis industry and has been involved in a lot of lending for years, and that's Chicago Atlantic, which trades on the NASDAQ under the ticker symbol REFI. Let's welcome back managing partner Peter Sack to the podcast. Good to see you, sir. Happy summer. How are things?
Great to see you guys. Life is good.
Yeah. What have you been up to lately? What do you think of all this energy and attention that's going towards the cannabis space right now? Because there's no shortage of drama that's going on, but that's the kind of the industry that we're in. But it really feels like there's a lot of conversation going on even outside of the cannabis realm that we've been hearing lately, which is I think encouraging in some ways. But what's your thoughts?
Yeah, some positive, some negative, but it's kind of like the all news is good news or whatever. It's good. It's good to have a conversation and a dialogue and a national debate, because the debate, even if it's 2 steps forward, 1 step back, is still incrementally forward pushing. Even there's a silver lining to all of this, like even raids in Glass House, which is a terrible thing, but still some silver lining in that you had dozens of federal officers wandering through a state legal cannabis facility, and no one seized cannabis product.
Correct.
That's a positive data point.
Correct.
We've got huge debates going on in Texas and in other parts of the country about hemp. And the Texas governor, I think, vetoed restrictive legislation around the hemp market. He pushed forward broadening of Texas medical market, which is a huge step forward, I think, in the debate of where cannabis should sit in this country, even while the state hasn't quite figured out how to regulate the hemp market. Dialogue leads to progress eventually, and it's refreshing to see.
Yeah, you make a good point, Anthony. That's actually a good point too, about how the feds were in there and none of the cannabis was actually taken. That's actually something that we've never really covered since that news came down. But what's that? And I don't want to get into company specifics because there's still a lot of information that we still don't know. But when you look at it that way, you kind of look at this industry in a different perspective. And yeah, it's not great from an optics standpoint as to what happened, but to your point, Peter, well said as far as none of the product actually being taken.
Yeah, I mean, it was a raid. It was a raid on a federally illegal business by federal agents.
Yeah.
And the narrative was spread far and wide. Everything from Kristi Noem to Homeland Security on Twitter to the White House were talking about this raid. Cannabis wasn't mentioned. Cannabis wasn't vilified. Cannabis wasn't touched. This was about immigration. And the fact that it was within a state legal business, but a federally illegal business, just goes to show you how far we've come. Because that potentially would have not happened, let's say 2016, especially with someone like Jeff Sessions patrolling around. But no, it was refreshing. It was good to see. And like Peter said, anything around the conversation is progress.
Yeah, I hear you.
Credit to the Glass House team for being very disciplined in their messaging and their communications around this and dealing with what's a very difficult and mine-laden situation.
Yeah, I hear you there. But so like we said before, more information, once we find that out, we'll communicate to everyone. But like we said off the top, we get to talk about capital markets. And I know that debt and distressed assets was front and center when we were talking back in May when the latest earnings came out. But for those that didn't know, you actually are creating, it's called Exploring Cannabis Lending Strategies videos, which is on your website. And your latest one, you mentioned that there's $462 million of lending pipeline tied to upcoming maturities. So clearly debt rollover is front and center. So walk us through the profit or the profile of a borrowers, in that pipeline. Like, are you seeing mostly refinancing, growth driven, stress induced? Like, what are you seeing?
We spend within our portfolio, we structure loans to be relatively short duration, 2 to 4 years in duration, with 2-year loans for single state operators and closer to 4-year loans for multi-state operators. And for us, those short durations aren't necessarily that's the only runway that we see for the company. It's really a check-in point, both for us and for the borrower. From the borrower standpoint, they may see that in 2 years they'll have cheaper, more flexible capital solutions. And for us, it's a check-in point on leverage and performance and growth prospects. And so across all the portfolio, every year, we're managing many maturities, and we have to decide, we have to compete with other operators in the other lenders in the space to re-win the business. We have to decide which borrower relationships we want to compete to win and how aggressively, and which are going to move on to other opportunities. And I'd say in some cases, even this year, we've had borrowers been successful getting very low cost of capital, leveraging their own success. And that's a positive for us too. We love it when a borrower goes from a 20% loan with us to be able to get a 10 to 13% loan because they performed so well.
Right.
And
on the operator side, is there an appetite, or is there a preference to, let's say, longer term capital versus shorter term capital? Because with what we're seeing in some of your peers, I would argue that the shorter term approach from a stress test perspective is a much more efficient approach, because on the lending side, you're shielding yourself from any sort of long-term trends that you're not seeing in the underwriting. And on the operator side, they're not stuck within the confines of something that's going to escalate and outperform their underperforming business. If I'm kind of looking at that correctly.
Yeah, I mean, on the borrower side, obviously, if they can get long-term, very cheap capital, they'll go for that. And you've seen some borrowers have that opportunity and execute on it. For example, Maramed the year before last did large bank refinancing, took us out of our facility in exchange for very long-term, inexpensive capital, and that was a smart move, I think, for them at the time. When capital costs are very high, when they're talking about a high teens cost of debt financing, I think many borrowers and operators will opt for a shorter term because they believe that the growth that we're funding is going to create a much better credit quality and access to cheaper capital 2-3 years down the line.
Yeah.
Are you seeing any increased stress with operators in the States? I mean, I know that we've seen a couple of publicly traded companies, not going to name names, but they're in restructuring mode currently, and some of the assets we can speculate are the lenders are going to get the keys, and others they might retain those assets, recap the company, and then start to operate those. I mean, are you seeing any more instances of that? Not even within your portfolio, but just abroad, as I'm sure those do come up as opportunities potentially for you as a lender.
Absolutely. I think there's a number of public and private platforms that capitalized themselves in the early 2020s or late teens, that as pricing compression has happened across the market, are struggling to keep up with debt service. And their restructuring activities, I think, generally are falling into a liability management and capital structure resizing concept, with the first, unfortunately, for better or worse, the folks that take the brunt of that are equity holders and unsecured creditors in the capital stack. And part of it's healthy. Part of it's creating an industry that is refreshed and recapitalized for growth, so you can build a company that has a much better opportunity for generating equity value in the future. And there does come a point where that has to happen in an over-levered capital structure. I think the best situations have a new company coming out of it that is conservatively capitalized, so that the management teams and the assets can be invested in for accretive growth.
Absolutely.
And
walk me through then. In the event, I'm just putting hype, like I'm speculating now, like we do in the media landscape. But if we get an announcement regarding reform rescheduling, it's going to actually bring a lot more attention, a lot more eyeballs to the space, and lending could actually come to the table, and this industry could slowly but surely start to pivot in the right direction. So with that, what should we be paying attention to in the event that happens afterwards? Like when it comes to risk thresholds, like what is your approach when it comes to the underwriting process and some of the risk thresholds that you're preparing for in the event that we do get some sort of reform? Because I think a lot of people want to know, what's this look like on the other side once the initial announcement is made, if it is made, obviously.
Yeah. Rescheduling changes cash flow profile of each operator in this space. And so on that fundamental basis, it creates an opportunity for greater debt capital and should make equity investments a lot more attractive. A big unknown is what happens to 280 tax liabilities that companies have
Right.
built up over the last 5 years. And that will still be an overhang to the extent that we don't have greater clarity on it. And it's an overhang. Uncertainty creates an overhang across the market, not just for capital structures, but also for fundamental operating decisions. It's much more difficult for companies to decide to do an acquisition if there's a big tax liability on the books and they don't know what's going to happen to it. It's much more difficult to do a merger, to do a new investment. Uncertainty slows down decision making across the whole space to the detriment of what could be really good growth
Yeah.
opportunities, investment opportunities.
Speaking of the industry, let's say fundamentally changing on the backs of perhaps a rescheduling announcement, do you think that that's also going to allow companies to, let's say, deploy capex to upgrade their facilities to increase the efficiencies within their grows? Because I've been talking to several operators, and let's say grows that were built in 2018, they're not up to speed, and these companies have not had the cash flow profile to be reinvesting that capex into those facilities. Do you see that as a trend? Potentially moving forward, which would then expand margins within these businesses further.
Absolutely. It's more cash flow to be used for any purpose, whether that's debt service or investment in cultivation or build out of additional dispensaries. It's just really powerful, really powerful.
There's a lot of things that you're going to see that maybe we're not seeing right now, as far as stories within the storylines here in the industry that we're going to, start to advance the space. And I think that we'll move quickly. But, when you look at this industry right now, what do you think are the most important things that we need to be paying attention to? Like you talked about tax liability. And in some cases, some companies may not acquire others because of those situations. So how does that all play out then?
One of the innovations that's arisen, particularly in the last 2 years, to address that specific problem is the rise of ESOPs.
Yes.
Over the next 2
Good point.
years, we're going to see more private companies converting into ESOPs. ESOPs, as a reminder, don't pay federal tax, period, neither
There you go.
280E nor ordinary. So their cash flow profile is very attractive. And then those companies, if they're so inclined, then become acquirers of other assets.
Mm-hmm.
And
So
so,
does an ESOP make it easier to, let's say, get acquired? Does it make it more? Does it cause any sort of difficulties in, let's say, looking at the business, or is it kind of net neutral
it's
within the
difficult.
structure of the company?
It's not necessarily simpler for an ESOP to be acquired by another company,
Yeah,
but it does
they
make
be the acquirer.
they'd be the acquirer. Exactly.
Got it.
Exactly.
Got
And
it.
so if you had no 280E changes in the next 10 years, you could
Mhm.
see a world where half of the industry is an ESOP because it makes so much sense, because private companies decide to convert to ESOPs and existing ESOPs go and buy other assets and buy other
Yeah.
companies and bring them under their fold.
Which I could see that.
I'd be lying if I didn't say that we haven't had an increased interest in people wanting to do ESOPs within the industry as far as outreach and a topic of conversation. For us, it is an interesting point
Yeah.
moving forward.
Yeah.
So what happens if 280E goes away then? What does that kind of halt its progression as to, like, what we've been hearing more and more pertaining to this, or how would that work then?
It does. The ESOP becomes a lot less relatively attractive
Yeah.
in a non 280 scenario for two reasons. One, obviously, federal taxes are lower if you don't
Yeah.
pay 280, and then two, the equity values of companies will likely increase. How the public companies trade and how private companies trade will likely increase. And ESOPs tend to have a ceiling in the multiple at which they can convert into ESOP, the valuation at the time they convert an ESOP. So if cannabis companies are trading at 15 times EBITDA or 10 times EBITDA, converting into an ESOP at 6 to 8 times EBITDA becomes relatively less attractive.
Of course.
You're absolutely capping your upside. One thing that we've seen in the last couple of weeks, or not couple of weeks, but a couple of quarters, are new markets coming online, albeit they are very restrictive markets. Low THC products, no flower. At what point in a market's life cycle do you start to take it seriously? Is that, let's say, no flower, low THC, very restrictive, like what we're seeing in Georgia? Is that too immature for you to start deploying capital in? And if so, is there a point where you do start to seed that market with capital from an asset standpoint?
I think Georgia has a lot of potential. I think we're limited by our framework of debt capital, and our framework of debt capital puts downside protection first. And one of the key elements of downside protection first is being able to loan based on trailing cash flows.
Okay.
And so that framework means that we're generally not investing in a market in its early stages, even if it has a ton of potential, because we need to be able to see existing cash flows already in place. So our framework suggests that the first capital to go into a market like Georgia should really be equity capital rather than debt capital. Others may disagree, but I think that's how we look at this. Look at those markets.
That makes complete sense. And then you're also shielding yourself from just the regulatory quagmire, because obviously, like, I know we saw Florida bring online smokable flower relatively quickly, that increased the cash profile of all the MMTCs down here. But Georgia seems to be just spinning in its gears, and you'd be putting yourself even to be compounding effects, like waiting for rescheduling, waiting for those products to come online, and the companies to be j- accelerating cash flows versus just going about the status quo.
Yeah.
With what they're currently in.
Yeah. I would add one caveat, though, that to the extent our existing borrowers or a borrower who's already in another state is looking to lever their operations in one state to expand into a place like Georgia, we're certainly willing to support that, because our investment can be based on both the existing operations and the potential of growth in this new, more frontier market.
Yeah, because I mean, those frontier markets in the Sun Belt and in the Southeast seem to be the conversations quickly gaining traction in Georgia, South Carolina, North Carolina. We had Kentucky come online, Tennessee. I'm sure we'll get with the program sooner or later, and those are large populous states that have large hemp markets in them right now that could be looking to do what Texas has done: curtail hemp, accelerate medical, and then start to be quite lucrative markets pretty quickly.
Absolutely.
So safe to say you're not having Senator Raphael Warnock over for a Sunday dinner anytime soon. Is that correct?
There's always a seat at the table for Senator Warnock.
Oh my goodness. I don't know.
That's the good political answer.
Yeah. I asked him a bunch of questions in Washington. He wanted no part of that conversation, but at least I got to burn a few calories off of how fast I was walking to keep up with him.
Interesting.
But have you followed, like, when you talk about new states and new markets, as Anthony pointed out, and you're, walk before you run before stepping in, but do you do your due diligence even before stepping in? You clearly do. And the reason I ask is you mentioned MaryMed earlier, and I was interviewing their chief commercial officer last week, and something that's not getting a lot of attention is that Delaware is going live adult use on August 1st. Do you know much about the market at all right now?
I do. I think it's going to be really attractive for existing players like MaryMed. I think the footprint of medical operators is going to be the first beneficiary and the leading beneficiary for a fairly long amount of time. And so I think MaryMed's very well positioned. Our challenge in a place like Delaware is that we're not well set up to do small loans to individuals or small grows. And so our ability to deploy a lot of capital there is relatively limited.
Makes sense.
But excited for the prospects. And then also thinking about what the knock-on effects will be on existing operators in Maryland. And so to consider performance when we're looking at stores that are on the Maryland-Delaware border, how that might impact their outlook.
Yeah. Did you see
go ahead, Chad.
I was going to say, because I know you brought this up, Anthony, you saw Terracin. They stepped out of Michigan. They announced a week and a half, 2 weeks ago. What have you noticed about the state of Michigan? Because that was a pretty bold move. It actually got a lot of good praise and positive feedback about Jason's decision to step out of Michigan. But what do you think are the biggest things that people may not be aware of when it comes to the Michigan market?
Mm-hmm. I think if you look at some of the public wholesale pricing that's been put out in Michigan, wholesale pricing in the state's actually been on the rise in over the last 6 months.
It has.
Yeah, it has. I mean, it's not a doubling, but modestly on the rise. And so I think there are rational players in Michigan that are limited by fundamental constraints of capital availability.
Right.
And so I suspect that TerraSen's an example of consolidation that's going to occur in the state, and rethinking of footprints when the next outdoor planting season comes around. And I don't know many folks that are investing in additional cultivation or significant processing capacity in the state. And the end result is consolidation and rationalization, which is a fine process.
Yeah,
Yeah, it's
I hear you.
natural. It's
Yeah.
natural. And then Pennsylvania is a market that we talk about a lot on a weekly
Yeah.
basis. How do you look at Pennsylvania when it's a heavily penetrated medical market, as is? It's got New Jersey on its border, several other adult use markets that are there. Like, how do you let's just say pro forma the upwards mobility that we can get from that adult use flip? When I think the assumption is going to be that even when the adult use market flips in PA, it's going to be kind of like what's going on in Ohio. The price is still going to remain premium, and you're going to still be able to go over those cross border markets to get a discount with those consumers that are already purchasing it. Is it look like it's going to be kind of status quo there for a while, regardless of the adult flip?
Yeah, I think Ohio is a better comp for Pennsylvania's flip than Missouri is,
Okay.
Okay.
given neighboring states. I think the other comparable point is just the oligopic nature of the Pennsylvania market. That
Yeah.
that so many of the existing cultivators that have large cultivation capacity also own a significant portion of the retail footprint, and so that drives more stable pricing, more stable wholesale pricing, but difficulty necessarily for independent operators to access shelf space.
Got it.
And so I think that makes it more difficult for investment considerations of independent operators that want to enter the state. Uh, Makes it easier for investment for businesses that have access to strong retail,
Yep.
but also suggests that the wholesale market and wholesale pricing will be relatively stable for the existing entrenched operators, and they're going to be huge beneficiaries of an adult use boom, even if it's not a 3x revenue and it's
Yeah.
closer to a 2x revenue.
Yeah.
So it'll be the rich get richer in PA, which is good for all intents and purposes for the most part, which is good for all intents and purposes for everybody
We got
watching this because it's most of the MSOs that are there at the top of the list.
Who's your top three, four again? It's what?
In
Uh,
PA,
yeah,
it's
Jushi, True Leaf,
Jushi, True Leaf, Cresco.
GTI,
GTI's got a
Terracin,
decent presence there, but then you've got Holistic. And there's a couple private operators that are solid in Pennsylvania as well.
Terracin as well.
Terrason's
Last
there.
thing I'll
Yeah.
last thing I'll leave you with is you ever heard of this new thing? It's called THC, hemp derived THC drink products and beverages. Man, oh man, is this taking the industry by storm? But how are you viewing this? Because it's taken over. But are you evaluating financing opportunities in this vertical?
We are. I'm actually really enthusiastic about it. Beverages through the dispensary channel have never made a significant inroads into consumption styles and patterns. And so my takeaway from beverages now being in Total Wine and stores across the country, I view that as pie expanding, not cannibalizing.
Mm-hmm.
And so I think
Mm.
it brings new consumers into the THC world that otherwise wouldn't be consuming. Uh, we've spoken to a number of beverage operators, and we'll continue to do so. It's until the business has been scaled, until there are some larger operators in the space, it's difficult for us to deploy significant amounts of capital. Just going back to that framework of debt and downside protection first, that in
Yeah,
the
I
early
hear you.
stages of an industry growth, equity capital is really the better risk reward fit than debt capital. Um,
Yeah, makes sense. It'll be interesting to see how this all looks in a year from now, just with some of the language that was announced last week. But I think it's gearing up for a completely different landscape when it comes to cannabis reform. And in conjunction with that is obviously the hemp space and how that'll look. But, right now, uncertainty, but this is what was needed. And really, if we can get some regulation for both industries, so much better for both and creates more opportunities in the long run, which is, I think we're on the path right now, don't you think?
Absolutely.
Yeah. Yeah. All right, sir. Well, good to check in with you. And wanted to have you on just to have a conversation to find out, yes, we got all this reform conversations right now, but I think people need to be mindful as to once the announcement's made, what are some trends that we see on the other side? So always good to talk capital markets and take a break from reform because this is the whole idea of why we launched this company to begin with. But good to see you. Thanks for checking in. And most importantly, let's keep in touch, okay?
Thanks for having me. Talk soon.
All right.
Thanks,
Thanks,
Peter.
Peter.
Bye.
Take care. Hey everyone, we just eclipsed 50,000 subscribers on our YouTube channel. We want to continue to grow this community. So if you haven't done so, make sure to subscribe now. We'd appreciate it very much here at the TDR Traded Black podcast. As usual, let's keep the conversation going. So leave your comments below and we'll get back to you with any feedback that you want to learn more of. In the meantime, enjoy the rest of your day and we'll see you next time on our latest Trade to Black podcast.